Welcome to our detailed exploration of monetary reform. Today, we dive into what monetary reform entails, its necessity, and various approaches with historical examples and data-backed insights. Monetary reform refers to the process of implementing changes to a nation's monetary system. This can include altering the currency, changing monetary policies, or even transitioning to an entirely new system. One reason countries pursue monetary reform is to stabilize the economy. For example, hyperinflation in Zimbabwe during the late 2000s led to drastic monetary reforms. Zimbabwe abandoned its currency and adopted multiple foreign currencies. Monetary reform can also mean improving crisis response mechanisms. For instance, after the 2008 financial crisis, many countries enhanced their monetary policies to avoid future collapses. The Dodd-Frank Act in the US is one example that implemented tighter financial regulations. Now let's look at another significant type of monetary reform: the adoption of digital currencies. Estonia, for instance, has planned to issue a national digital currency called Estcoin, which aims to enhance its digital economy. One question often posed is whether monetary reform is more beneficial in developed or developing nations. Benefits can be extensive in both. Developing nations may see more market stability, while developed nations might achieve greater economic flexibility and crisis resilience. To understand the impact, let's consider data from Iceland's monetary reforms post-2008 financial crisis. The GDP started recovering sharply post-2011, following monetary and fiscal reforms. Another key area for monetary reform is cryptocurrency regulation. Governments worldwide are exploring how to integrate and regulate cryptocurrencies within their monetary frameworks. An essential part of monetary reform is to ensure public trust and understanding. Policy shifts must be communicated clearly to avoid panic or confusion. Public education campaigns are crucial during these times. Let's examine theoretical models that help in structuring monetary reform. For instance, the Taylor Rule suggests how central banks should change interest rates in response to changes in economic conditions. One prevalent question is, what are the risks associated with monetary reform? The most significant risks include destabilizing short-term economic movements, inflation, and social unrest. These are risks that need careful management. To sum up, monetary reform is a powerful tool that, when properly implemented, can stabilize and strengthen economic vitality. While it carries inherent risks, the potential benefits often outweigh them.